If you've been paying attention to the property markets lately, you'll know there's no shortage of advice out there. Some good, some, well, maybe not so good. But what if you could cut through all the noise and base your decisions on decades of real evidence, proven strategies, and a few timeless principles? Well, that's exactly what we're going to do today when I'm joined by Stuart Wemyss, a highly successful and respected financial advisor and author. Stuart, who's Director of Pro Solution Private Clients, has spent decades helping investors build their wealth safely and successfully. And recently he distilled what he's learned into what he calls 4 golden rules of property investing. These aren't gimmicks, they're not quick fixes. They're, in my mind, a powerful principle grounded in data and evidence. And they've stood the test of time. So welcome to another episode of the Michael Yardney podcast, where I help you cut through the clutter of the many mixed messages surrounding our housing markets so you can safely develop financial freedom. Whether you're starting out or just looking to fine-tune your property portfolio, I believe my chat with Stuart today is going to give you some great insights. So let's get on with it.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Stuart, welcome back to the show. You've been a regular guest for quite a few years now, and each time we catch up, I love the dose of realism and evidence-based information you bring that I know our listeners appreciate.
Yeah, thanks, Michael. I think a rules-based approach to investing just makes it a lot easier. Firstly, to understand the mechanics of investing, and then to understand, what you really need to focus on to be successful. And I think with investing, no mistakes happen just because random luck. Random luck really isn't a big deal with investing. Most mistakes, I think, are predictable from the outset. That is, that you're following a path that doesn't have any evidence, lacks fundamentals, these sorts of things. So, which is really why I like a rules-based approach.
Well, beginning investors would see there's hundreds of things to think about and consider, and sometimes that puts them off. So I like the fact that you've actually written a blog recently that break it down to just 4 golden rules. Yeah, there's hundreds of things you can know, but maybe there's 4 rules you should know to help you outperform the averages and stop you making mistakes. And it looks like it's the culmination of your many years of research and personally investing and with clients. What made you sit down to try and distill this into such a simple as underplaying how powerful it is, but a simplistic 4 rules blog?
Yeah, I was reflecting, Michael, as I said, I've written probably about more than 500 blogs over the last 10 or 12 years, and more than 150 of them on property investing. It seems like I can never run out of anything to write about. Hopefully it's still good quality insights. But what I really did is reflect, what are the blogs that I've written recently, when I say recently, over the last 5 years, that I think that I look back and go, there was something really fundamental there. That was a real fundamental shift or insight because again, as I said at the beginning, I meet a lot of investors, and you see a lot of property portfolios and you see a lot of mistakes. I mean, I see a lot more mistakes than I see people get it right. In fact, it's very rare that I come across a property portfolio and go, yep, I would have bought all those properties, or I think these clients.
We've made the same mistakes ourselves over the years.
Of course we have, yeah. So we're not picking on people. If we could then just solidify everything into simple rules and to stop people getting distracted by shiny objects or buying the wrong type of property or these sorts of things, what is it? And I went through the archives in terms of the blogs, and I picked out these 4 rules as the ones that I think are arguably the most important. And I'll put it this way, I think if you follow these 4 rules, your probability of success is substantially higher.
Okay, well, I agree with them, by the way, having read them, and we're going to work through those. And as I said, I'll leave a link to your blog and to your Investopoly podcast in the show notes. But I like rule number 1 because I think a lot of beginning investors break it. And you're basically saying the first golden rule is to focus on capital growth before income. Why do you see this so important, and what's the danger of prioritizing yield too early in the journey?
Because there's always a tension for property investors, especially first-time property investors, to not disregard income. And the reason for that tends to be because first-time property investors tend to not be in an overly strong financial position. They
Yes.
tend to be just starting out. They don't have a lot of equity. They've had to save hard to get this deposit. Their income is growing typically because they're young. They're just starting their careers, but it's certainly not, it hasn't peaked out yet in terms of their, what they expect over their lifetime. So every dollar matters. And so, of course, there's this natural tension to when I'm contemplating an investment to buy an investment that costs me less to hold. And I think that hopefully, if I try and optimize both growth and income, I can have both. I can have my cake and eat it too. But it's like that saying, if you end up trying to chase two rabbits, you probably catch neither. And so instead of saying to investors, just focus on growth, don't care about income, I've reframed it to say, focus on growth before you buy the property and then focus on income after you own the property. And I believe that's a much better approach, because if I'm just focusing on capital growth, I'm going to focus on all the things I can never change about the property: the location, the land size, the land orientation, all those sorts of things I'm going to have to live with for the time that I own that asset. But then once I've paid for that asset and it's in my name, the title's in my name, then I can start thinking about, completely forget about growth because that's done now. Now I can just think about all the things that are going to change the income profile of that asset. And that's really the improvements. We can always change the improvements on a property at any time we own it, but we can't change the things that impact capital growth,
Which is location in general,
which
in
is
investment
location
grade
in general.
locations. Yeah, I
Yep.
found people chasing cash flow are really thinking about the here and now rather than the long term, and they buy properties that may actually solve a bit of a short term problem. They can hold them, but it won't give them the long term results they're hoping for. But let's be clear, no particular property is cash flow positive or negative. It really has to do with the finance. But there are some properties that are more likely to outperform with regard to capital growth. And you discuss that with regard to investment grade properties in your blog. So what makes an investment grade property that's more likely to have a superior capital growth, Stuart?
Yeah. So the way I would frame it is, if I'm searching for an investment grade asset, really what I want to do is buy land. Okay, sure, there's a dwelling on that land and it allows me to have a tenant and earn income. But really what I'm mostly concerned about is I just want to go buy a parcel of land. And then, as I said, I can always improve that land down the track. But so I want to buy land in a location where there's an imbalance of supply and demand. So in well-established, built-up blue chip suburbs, land is finite. There's no more. There's no more of it. It's finite. Whereas in outlying areas, the proximity to vacant land could be abundant. There could be, if I'm buying a new estate, I'm competing against a lot of vacant land, not only in that estate, but the next estate or land release that's going to be released to the market in 2 or 3 years' time or whenever it is.
Now, let's make it clear it's land component, and so family-friendly, good established apartments also have a land component. I spoke to somebody a couple of weeks ago who regularly listens to our podcast, and he quoted you, and he said, because we were suggesting buying a property in Sydney, an apartment in Sydney where it was well within his budget, and he said, I've listened to Stuart Wemyss and he would not allow me to buy an apartment. And I said, no, I know Stuart owns apartments. I do. It's not a high-rise apartment with 200 on the block of land. I think we're saying the same thing. It's the value of the land and the right location.
100%, Michael. I mean, there's always going to be a component of land and building value. It's just, what is the split? And we want more of the value that we're paying initially to be in the underlying land, because that's the bit that's going to appreciate. The building value is either going to be stagnant or depreciating, or it could appreciate by a small amount depending on what it is, but it's really the land that's going to do all the heavy lifting. So if you spend most of your money on the underlying land value, then what you're doing is setting yourself up to maximize the capital growth rate. The other thing I think is important, Michael, is to look for a long-term history. That's the thing that these established blue chip suburbs have, is they've got a track record. So you're not throwing a dart at it up, or you're not hoping that if I invest in this location and here's all the demographic data that suggests it's going to perform well over the next 10 years. That's okay, but that comes with greater risk because it might not happen. That data might be wrong. It might be outdated. It might not be reliable. Instead, what you're doing is saying, I'm going to buy in an area that's had a 40-year track record of delivering fantastic growth. There's no guarantees in the future, but to me, that reduces risk substantially. So having an imbalance of supply and demand, long-term history, and a strong land value component is really important. I just want to add one additional thing to that, Michael, is that with the tension, when we're talking about the tension between income and capital growth with asset selection, people just need to be really careful about what projections they might believe. If we look at the market, the property market that is, in pretty much any capital city, over a 40-year period, the total return, so that's gross rental yield plus growth, is around about 10%. It actually doesn't vary that much. It's just the combination of growth and income that can vary. So some markets have been higher income, other markets like Sydney, lower income, but higher growth. So if we think that generally the market achieves a 10% return, then I would never go into an investment expecting that I'm going to get more than 10% in terms of total return. I hope for it, but I wouldn't expect it. And this is where I think some people end up making a mistake. They think, well, I can buy in this area because I get a really high rental yield, 5%. But I also think I'm going to get 6 or 7% capital growth. That means that their starting assumption is the total return from property in that location is going to be between 11 and 12%. It's higher than major capital cities. I think that people need to do what people need to do in that situation is reflect back and go, is that a realistic expectation? And I would say no. I think any expectation of a return greater than 10%, pretty much for any investment or any asset class, I think starts to get into the realm of being unrealistic.
Makes sense. One of my very early mentors in property taught me that residential property in Australia, and it's different overseas, is basically a high growth, relatively low yield investment. And he was saying people who try and change that around, his words were, bastardize the investment. So, yeah, there's been all sorts of things, having rooming houses and co-living and dual occupancy and all sorts of other things. Don't mess up what residential real estate is. Now, your second rule is the importance of understanding property cycles. You say timing isn't everything, but understanding the cycle can fast track success, Stuart.
Yeah, I mean, we can, and I've got a chart that I've shared many times in your podcast, Michael, and on the Property Update website that shows how property prices have changed since 1980, so sort of 45 years. And we can distinctly see that there's two cycles, a flat cycle and a growth cycle. And if you study each cycle, the flat cycle tends to last around 7 years and the growth cycle tends to last 10 years. So you put those two cycles together, that's a period of 17 years. That's when you're going to enjoy average growth. Let's call it 6 to 7% in terms of median house price growth. Now, if I buy just before a flat cycle, it means I've got to ride that flat cycle out, which is 7 years of virtually no growth. And then I get into a growth cycle. So I've got to hold that property for full 17 years, if we're working on averages, to achieve an median return, an average return. However, if I'm lucky enough to time the cycles perfectly, and because I buy just before a growth cycle, we know on average, the average return throughout a growth cycle is obviously above average return. So it tends to be sort of circa 10%. Well, I'm off to the races because my returns, my long-term returns on each situation, exactly the same. The longer you hold the property for, the closer your returns revert to the median. But it's very helpful to get those returns in the earlier years because it means that, firstly, I'll feel more comfortable. If you buy a property in 3 years' time, you've seen some really strong growth. It makes you feel good about moving forward. But also I can then leverage that growth into additional assets as well.
Yes.
So you don't need to get timing right. You know, as I said, it's really time in the market. Even if you completely mess it up by just before a flat cycle, if you've bought a really good quality asset and hold that asset for 30 years, you'll do fine. It will do its thing. But it is much more helpful if you're able to be cognizant of cycles. And you don't want to go and invest in a particular geographical location if it's just been through a 10-year growth cycle, for instance. Chances are your shorter term returns are going to be below average. But conversely, if you can pick a market that is just about to come out of a flat cycle, like Melbourne, you potentially expose your portfolio to higher than average returns, which, as I said, there's a compounding impact to that as well.
Of course, not only geographic locations, but there are markets within markets. Even though Australia's got the same interest rates and the broader economy, within each state, there's houses, apartments, townhouses, outer suburbs, inner suburbs, different price brackets. The affordable market works slightly differently to the more expensive market. So that's what the averages don't show well up, do they?
No. I mean, all it's going to tell you when you look at these cycles is where is the general market conditions. And what that really tells you is where is market sentiment. Because in the short term, sentiment drives markets. In the long term, it's fundamentals. And so what we tend to see happen is that market will go through a growth cycle. It will become a little overcooked. So the growth cycle will extend for another 2 to 3 years beyond intrinsic value. And then it'll have a breather. It'll have that 7 years of flat, no growth, just for the market to really, for the fundamentals to catch up with the
Yeah.
previously high sentiment. So it's not an exact science either. It's not to say that, just because Brisbane's just been through a 7-year growth cycle, all property in Brisbane is overvalued. That's a nonsense too. Again, it's not an exact science, but it does give us a good sense of where properties are in the cycle. And I think it's a really interesting conversation, because if we were recording this podcast 20 years ago, firstly, there weren't podcasts 20 years ago, but if we were, there was
Would have been a pioneer.
yeah, we're pioneers. That's right. There would be a natural tendency for most people to go, I don't want to go and buy a property in Brisbane. I don't know Brisbane. I know Melbourne. I live in Melbourne. I feel more comfortable. I don't know about you, Michael, but I think people are much more open these days to investing outside of their domicile.
Yes, they are. I think with all the information available on the internet, people understand that differently. So we opened our Brisbane office in 2006, which is almost at 20 years ago. But there were very few interstate people recommending to invest in other states. Now, still, people love to invest close to where they live, close to where they want a holiday or where they want to retire. They're the wrong reasons to do it. So understanding the cycle, in my mind, is critical. And as we've said in a previous show not that long ago, we believe this is a good opportunity to get into the Melbourne property market, which now for the last couple of months has had very strong growth. And recently, KPMG, ANZ Bank and Domain all changed their forecasts for 2026 and all suggesting that Melbourne is going to be the strongest performer. Not boom. They're also suggesting growths in the order of 6% per annum. But this, doing the right thing, it's not too hard to outperform the averages. Now, as we go through your 4 rules of property investing, the third one was understand the maths behind success. Now, that's what I like about you, have it coming from an accounting background. In your article, you break down why borrowing, the full cost, negative gearing, compounding are all critical. Maybe you could just explain what you're on about there.
Yeah, and I think you've said it too, Michael, many a time, that property investing is more a game of finance than property. Is that right?
Well, you say property investment's a game of finance with some houses thrown in the middle. Yes.
Yeah, there you go. Yeah. And I'm really going to the same end. It's not really property itself. I
buy property to give me more money.
Yes.
And more properties.
Yeah, sometimes there's a debate, which is better, property versus shares. I think the debate is misguided, because both have their pros and cons, and I would argue most people will be best served investing in both, and most people do. Supers tends to be invested in the share market. But really, the way I would reframe the conversation is gearing versus no gearing, because the geared element in property is the thing that can really supercharge the return. That's really what's doing the heavy lifting. The fact that I can go and buy a property and not put any of my own money in initially, my only contribution to the investment is the capital that I have to contribute towards meeting the running costs. That's my contribution, but I don't have an initial contribution. And people go, yeah, well, you can gear into the share market too. And of course you can. But firstly, most people don't feel as comfortable doing so. We know the share market has twice the volatility of property markets, 20 versus 10%. So the lower volatility in property makes people feel more comfortable. The fact that it's cheaper and easier to do it with property. And lastly, I don't have margin calls. If my property value falls, as long as I'm keeping up with the loan repayments, the bank's not going to care. They're in the business of lending money, not repossessing homes and selling them. So for those reasons, most people are more likely and happier to gear into property. So that's the first element of maths, is that the best way to increase your return is to borrow the full cost and then try and minimize the holding costs. As I said, focus on growth. And then once you bought the property, think about the income profile of the asset. The second element of it is the compounding capital growth. particularly for people that are still working, they're accumulating assets as opposed to retirees. Their goal isn't to generate more income per se, because more income creates more taxation liabilities. The goal is to hopefully get most of their return in capital growth and a lot less in income. And the fact that negative gearing means that I can claim a tax deduction, it means the federal government is paying 30 to 50% of those holding costs. So it defrays some of the cost and capital I need to put in. And if I'm investing in a property that's only giving me a net rental yield, so after expenses, of say 1.5 or 2%, and the rest of the return is coming in capital growth, mathematically, that's the asset that's going to have the highest probability of putting a lot of money in my pocket down the track when I go and sell it after all tax.
Stuart, I don't think most people realise when they eventually want to retire, live off their property, their asset base, the vast majority of it isn't going to be the rent they've achieved. It's not the mortgage they've paid down. It's not the income they've put in. It's actually going to be the majority of their capital asset base is going to be the capital growth they've achieved and the compounding, pyramiding capital growth they've achieved over the decades.
Yeah, 100%. And, the other thing too is if you have, and I did this exercise, Michael, for a blog that's coming out, if we look at the increase in land tax in New South Wales and Queensland over the last 10 years, land tax revenue, it's increased by 13% per annum. In Victoria, 15% per annum. So Victoria's always held out as this taxing state, and it is, but they're all as bad as each other. That shows those figures aren't that different. And that takes us up to this year. In fact, Queensland's projecting their forward estimates another 13% per annum over the next 4 years, whereas surprisingly, Melbourne's half that amount. The thing is that there's always going to be someone that's going to take that income away from you, whether it's the government, whether it's expenses related to the property management or maintenance, whether it's a tenant, all those sorts of things. It's unascertainable. It's not, you can't sit there and go, I'm going to rely on this income, because that income may or may not be there. But the thing that you're going to regret 20 years from now is not buying a better quality asset, because the holding costs are probably the same. You're going to get the same rent, similar rent. The interest rate's going to be exactly the same. That's your major cost outgoing. Your negative gearing benefit's going to be the same. The differential is in growth. And so that could end up costing you literally millions of dollars in missed capital growth.
Well, if some people are wondering, can capital growth still occur? Aren't properties overvalued? Last month, we had our regular monthly chat, and we discussed property values still double every 10 years, grow at around 7% per annum. So if you're watching this or listening to this, first of all, keep listening. Secondly, subscribe if you don't subscribe to the podcast anyway. And then go back to the last chat I had with Stuart Wemyss, where he explained why we think that certain properties are going to keep compounding at that sort of level, which almost brings us to your fourth rule, Stuart, which is understanding future borrowing capacity or buyer capacity, because is one of the rules. It's going to be important that you own the sort of property that's going to be in continuous strong demand by other people who can afford to buy it, even if you're not going to sell it, and also to tenants who can afford to and be prepared to pay higher rent over time. And so some areas are just not going to fit into those criteria.
No, that's right. And that's what I would implore people to ask themselves to if you come and say, look, Stuart, buy 13 Smith Street, the thing that I should be asking myself is, why is Michael recommending 13 Smith Street? And how am I confident that if I pay $1 million for that asset, that it's going to double in value on average? It's not going to do it every single, the growth isn't going to be straight line. But on average, it's going to double every 10 years, which means in 10 years, it's worth $2 million, and in 20 years, it's worth $4 million. So I need to have a clear understanding of what is going to drive, which buyers are going to drive the price of that asset from $1 million to $4 million over the next 20 years. Where is their borrowing capacity going to come from? If it's about borrowing more, if it's about servicing that borrowing capacity, where is their income growth going to come from? If it's about other sources of wealth, inheritances, these sorts of things, business sales, where is that going to come from? Because I can't expect to achieve 7% or 7.2% compounding capital growth unless there's going to be enough buyer demand and shortage of supply, and those buyers have enough financial resources to keep perpetually, incrementally pushing those prices higher. So I think more so than ever, and as we discussed in that podcast that you just referred to, the previous few decades, the key thing that changed was borrowing capacity. It doubled over a sort of 10 or 20, 30-year period. Borrowing capacity is going to remain stagnant, in my view, over the next few decades. So it's really going to be based on income and other sources of wealth in order to drive property values. And we said that in that episode, Michael, because this is where people can be distracted. Quite often, new areas can start low in terms of prices. A house will sell for $500,000. But once it gets to the median house price, that ripple effect goes out. People go, well, why would I spend, if the median is $1 million, why would I spend more than $1 million in this area when I can buy next door, the suburb next door, for 600,000 and so on and so forth. And it just sprawls out like that. Yes, growth can occur for shorter periods of time in any locations. But what we're most interested as investors is the average growth rate over multi-decade periods.
Of course, we keep hearing the media and others say that housing is unaffordable. But if that was true, property values wouldn't have kept rising year after year for the last 45 years that the Australian Bureau of Statistics have been giving us these figures. The reality is housing is affordable to certain people and clearly, unfortunately, not affordable to others. So as an investor, it's important in my mind to understand where those buyers who can afford to pay more are. And again, it's not just buyers, but we want tenants, because not all tenants rent because they can't afford to buy. They rent for lifestyle and other choices. And so therefore, we've got to invest in the locations that appeal to them.
This is the confusion in the debate around housing affordability that I think gets lost, Michael, is that some cohorts are arguing that if we make housing affordable, everyone will own a house. And that's clearly just not true. About 30% of Australians rent, and about 30% of Australians have always and probably will always rent. Doesn't suit everyone to own the home that they're living in. So we need to make sure we've got a healthy rental market, in particular to make sure that those people that are willing, able and want to rent are able to do so in the locations where they want to live, not just in new build areas, so we can build a whole bunch of new housing, but also in more established areas that offer different levels of convenience.
So look, there are 4 great rules to start with. Focus on capital growth, understand the property cycle and take advantage of that. Do the maths, understand that property investment's a game of finance, and consider future buyer capacity. In other words, make sure that you own the sort of property that will be in strong demand by people who can afford it in the future. Clearly, there's lots of other rules, and I know that we'll discuss them in future shows, and you have them in your podcasts and blogs. As an accountant and a financial planning firm, I know you'd probably, if you had a chance, also throw in a rule about owning things in the right structures in flexible ways and thinking about estate planning. How do you help your clients at Pro Solution, private clients?
We develop a long-term plan, Michael, that could include a combination of property and shares or super, whatever the assets might be. And then we work very closely with them over many years to implement that plan. There's lots of value in developing a long-term plan, but it's really the correct implementation where the value is realized. And we believe that many decisions are multifaceted. Property investing is a perfect one. It includes financial planning, taxation, borrowing, all those sorts of things. So we construct a multifaceted team around every client to make sure we exhaust every opportunity and every risk.
Fine. Well, I'll leave a link to the show notes to your podcast, your blog, and to Pro Solution Private Client. Stuart, thank you. So you've given us 4 rules. Clearly, there's lots more. So I'd like to get you back in a month's time to go through some more ideas on property.
Sounds like a plan.
Thank you, Stuart.
Thank you.
If you're a regular viewer or listener to this podcast, you know I have a property trivia question each show and give you, my listeners and viewers, an opportunity to win a copy of one of my best-selling books. At the moment, it's Michael Yardney's Guide to Investing. And just answer the question I'm about to ask you. Go to propertytrivia.com.au and enter your answer. And each week, 3 correct answers win a hard copy of my book. And don't worry if you're listening to a slightly older show, your entry still counts. And everyone gets a copy of a new property report, and I've just updated the one that people are getting at the moment. So here's this week's question. In Australia, what's the maximum period that you can have for a residential home loan? So what's the maximum period most residential home loans are structured over in Australia? Go to propertytrivia.com.au, leave us your answer, and good luck with the question. Well, a moment ago, you heard Stuart and me speak about 4 rules to help you make your property investment successful and make sure that you, well, at least outperform the averages. And if that's the case, value of your portfolio is going to double over the next 10 years. So do you know where you are going to be in 10 years' time in 2035? Do you know what you're going to achieve? Are you going to have achieved financial independence? Will you have built a property portfolio that gives you the passive income that you're looking for? Now, I remember a couple of weeks ago, I actually caught up with Paul and Annette, who are now in their early 50s, and they're planning to transition to the next stage of their property investment journey. They're wanting to retire in 10 years' time. So they've got a substantial asset base now. I don't see many clients anymore, but I've been working with them for quite a number of years, and so I enjoy our annual portfolio reviews. And it was fantastic to see that they'd built a successful portfolio of properties in all 3 big capital cities. And running the numbers in our sophisticated planning software showed the passive residual income, the cash flow they're going to get in 10 years' time, and that it's going to give them the financial choices, the freedom that they're looking for. Now, some people would say they're lucky, but I know that's not the case. I know they planned to become the people they plan to become by having a strategic property plan, receiving good advice from the team at Metropole, but just as importantly, acting on it. And now they feel they're in control of their financial future. They know where they're going to be in 10 years' time. Do you? Would you like us to run the numbers for you through our sophisticated planning software? In fact, we do that even before we start talking about buying the next property. So go to metropole.com.au and have a complimentary wealth discovery chat with one of our wealth strategists. Let's discuss your options. See what your financial future holds. And you'll find we're much more than just another buyer's agent. We help our clients safely outperform the markets and create intergenerational wealth through strategic property and wealth advice. Our planning software will tell you where you're going to be in 10 years' time if you keep taking your current path, or more importantly, what you could do if we change direction. Go to metropole.com.au. Let's have a chat.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to share a story I read a couple of years ago, and it came to mind recently because of what's happening with AI. Look, let me paint a picture for you. We're living in an age where with a few clicks, AI can write your emails, summarize your research, interpret your data, even mimic your tone of voice. It's efficient, it's impressive, but I'm also seeing that can in some ways be dangerous. Let me explain. Because the more you outsource your thinking, the more your ability to think begins to shrink. And it reminds me of that story I was mentioning a moment ago that perfectly captures what's going on. The story I read was that Max Planck, a Nobel Prize winning physicist, became famous, and he gave lecture tours around Germany, and his chauffeur, having heard the talk dozens of times, joked that he could give it himself. So Planck even said to him, okay, look, I got an idea. Why don't you do that? So one day the chauffeur got up on stage, dressed in Planck's clothes, and delivered the talk flawlessly. And the audience applauded. And then somebody asked a simple follow-up question. The chauffeur, he was stumped. Thinking quickly, he said, that question's so basic, I'm going to let my chauffeur answer it. And he pointed to the real Max Planck at the back, sitting at the back. And he apparently was wearing the driver's hat. Well, that's what the story goes. Now, look, it's a great story. Maybe it was made up, but the lesson was spot on. There's real knowledge and there's what I'm calling chauffeur knowledge. There are 2 kinds of knowledge. Real knowledge is earned. It's the depth that comes from rolling up your sleeves, grappling with nuances, getting it wrong, refining your thinking, at what you're allowed to adapt when conditions change. And there's chauffeur knowledge. Chauffeur knowledge is borrowed. It's surface level. It repeats. It sounds impressive. Obviously, according to the story, it crumbles under questioning. It's the sort of stuff you can copy and paste from ChatGPT or bluff your way through buzzwords and bullet points. But here's the uncomfortable truth. AI is accelerating the spread of chauffeur knowledge. Every time we let the machine think for us, we risk weakening the mental muscles we use to learn, to reason, and to discern. Now, I'm not saying AI is bad. Far from it. I use it every day. But here's a critical distinction. I suggest you use AI to multiply your real knowledge, not to replace it. So let it assist your thinking, not do your thinking. Let it support your strategy, not define your strategy. Let it challenge your ideas, not become your only idea source. Because while AI might help you sound like an expert, if you haven't done the work, you're just a chauffeur in a Nobel Prize winner's jacket. So here's the takeaway. In the days of AI automation, your most valuable asset is still depth of understanding, depth of skill, depth depth of thinking. So be careful who you listen to, because there's lots of young experts out there using AI to say that they're property experts. AI can write a compelling sentence, sure. It can't build wisdom, though. That still belongs to the experts. So keep learning, keep questioning, and my suggestion is stay in the driver's seat, because when follow-up questions come, and they always do, you want to be the one with the answers, not the script. Similarly, be careful who you're getting advice from. Get advice from the expert, not the chauffeur. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?